The Bank of Canada just cut rates again, down another 25 basis points from the peak of 5%, now at 2.5%. So basically cut in half in just over a year. Sounds like smooth sailing, right? No, not so fast. Weak job growth, slowing economy, and inflation dipping under 2% did give the bank the excuse to cut. But here's the twist. Food and services are still running pretty hot, and that's why rate cuts won't be crashing back to zero anytime soon. History tells us one thing, that rate cuts rarely come alone. Most big banks are already betting for another one coming for the rest of this year, either in October or December. And here's what it really means for Toronto real estate. BMO is calling this an inventory clearance sale. Condos are flooding the market, new builds, investor-owned units, relistings, detached homes and semis and multiplexes are holding up better. Basically, the higher the sales to new listings ratio is on this chart, the stronger the market. So you can see houses are stronger, but even then, rents are softening. And so investors are definitely a lot more cautious. And that is why prices are still down about 10% from the average of last year. So here's the real question. If wages and home prices are both roughly 25% higher than pre-pandemic levels now after prices came down, but mortgage rates are still above the 2019 levels, how close are we actually to 2019 affordability levels? Just do the math. A 10% discount from a motivated seller gets you basically back to 2019 conditions. Push that to 15% discount and you're actually better off than you were back then. That is why end users will continue to creep back in. Long-term investors chasing cash flow will slowly return too. The balance of power still firmly in the buyer's hands. Here's an example of what you can buy in the Toronto multiplex market right now. You can buy a turnkey 3-unit home for around $950,000 in West Midtown Toronto. And with a 20% down, that's about $200,000 of capital that you need. And then afterwards, as 3 units, after you pay for your operating expenses, after you pay for your mortgage, you're going to be looking at positive $1,200 of cash flow every month, no renovations needed. Later, if you end up building a garden suite in your backyard when you have more money, you can unlock even more rents and more upside when you're ready to expand. Is this the bottom? Maybe, and maybe it's a setup for a slow grind higher. Either way, this isn't about chasing crazy growth. It's about finding those clearance rack deals that still cash flow very well today and grow tomorrow. We've done this in our own portfolio and we've helped hundreds of clients do the same. So if you are serious about investing in Toronto, just book a call with our Elevate team at this link. We'll walk you through exactly how to find the right opportunities, crunch the numbers, plan the renovations with you, place tenants if you need it, and manage the whole thing so that you can focus on growing your wealth. If you are ready to get started, just go over to this link here and let's chat.